It's time for our weekly market monitor, who has names of dividend-paying stocks he says you may want to consider for your portfolio in this low interest rate environment. Joining us, Bob Phillips, Managing Director and Partner at Carson Wealth. Welcome, Bob. Nice to have you here.
Thank you, Sue.
You say dividend payers are the cheapest versus the non-payers in 15 years, and Masco is your first pick for us. Why do you like it?
They've done a great job restructuring the business and cutting out high-cost businesses over the last 5 years or so. And they got a great tailwind behind them with demographics and housing starts. I think will be picking up with housing formation getting much larger going forward.
Texas Instruments, the semiconductor industry in many parts has had some headwinds in the last few years, but it's tough to see that in this stock here. It's had a pretty good ride, hasn't it?
It has, Bill, and they're a cash flow machine. I think their free cash flow is close to 40% of their sales, and they've done an incredible job giving that cash flow back to stockholders through increasing dividends and stock buybacks. Since I think they've reduced their number of outstanding shares close to 49% since 2004 with buybacks.
And JP Chase is a stock that you recommended a year ago, and the dividends have increased steadily since then.
They have, and I think they'll keep doing that going forward, Sue. It's a global bank, and I think they're the strongest of the global banks. So as the overseas banks pull back, JP has great opportunity to keep expanding. So people are concerned about and fearful of banks in this low interest rate environment, but I think they're currently paying a 3% dividend, and I think that'll increase by 8 to 10% a year going forward.
Quickly, we should clarify, it's not just a dividend payer that you're looking for, it's a dividend grower that you like, right?
Absolutely, Bill. I think in this world, the question is, where does your cash flow in the future come from? And typically, high dividend-paying stocks aren't going to be increasing those, and they tend to be risky. So you want companies that have an ability to grow sales, have a desire to give that cash back to stockholders through dividends and or buybacks, and also have very strong balance sheets.
Bob Phillips with Carson Wealth. Thanks so much. Have a great weekend.
Thank you.